afternoon, traders. Happy Tuesday. Hope you had a nice, long, restful weekend. I know I did. It was so nice to just have a day off, right? My boys and I, we went to our lake house in Arkansas, and it wasn't too much that we did. Just kind of hung out, and then got back Sunday. And yesterday we all just totally vegged. It was great. I needed a veg day. How about you? I hope your weekend was just as good. Hey Yorn, good to see you. Good to see everybody here. I saw this, I haven't watched it yet, but I saw this video that I wanted to chat about. Give me just a second here to load it up. It says why the Fed's cuts are causing interest rates to rise instead. Now listen, we're all dealing with inflation, right? And nobody's immune from it, but I'm really curious as to why the video here from Heresy Financial, great channel. I watch a lot of his stuff. Curious to see why he says that the Fed cuts are going to cause interest rates to rise instead. By the way, good to see you, Tug, Jean-Louis, Michael. Glad everybody's here.
Over a year after keeping them historically high, and they did so by a historically large cut at 0.5%. But why are interest rates across all other forms of debt actually moving higher after the Fed's cut? Well, it's because of a combination of a couple factors we're going to talk about. Number one, the Federal Reserve controls some interest rates and only influences others. Number two, government spending and borrowing also has an influence on many interest rates. And number three, the reason why this matters for you is because interest rates affect you, number one, in how much it costs you to borrow money, but number two, how much it costs you to buy things that other people use debt to purchase. If you don't know who I am, my name is Joe Brown. I'm a former stockbroker who spent years advising the
Hey Wes, hey Peter, hey Alex, glad everybody made it.
1% advisor. So Reserve actually outright controls. And when people talk about the Fed cutting rates or raising rates, this is actually what they are referring to. Basically, this is the amount, the interest rate that banks get paid for holding overnight reserves. You can see from the beginning of this chart until about 1980, the Federal Reserve was raising the Fed funds rate. And after that, they were on average lowering the Fed funds rate. This led many to speculate during 2021 and 2022 that the Federal Reserve would not be able to actually raise rates much because for the last 40 years, every time they raise rates a little bit, they have to drop them suddenly afterwards. But they blew through that trend, and for the last year have been holding rates steady at between 5.25% and 5.5% until this very recent surprise drop of 0.5%. And if we zoom in on just the last couple of years, here's what that little drop looks like. Many people.
Now, I'm gonna go back just slightly. When I do a lot of consulting, so I do lots of consulting with financial institutions. One thing I talk about with them is the Fed, because financial institutions base so much of their balance sheet on what the Fed interest rates are, right? Because in theory, that's the most risk-free rate you could get. And right now, with that being around 5%, I mean, that's big money, right? Just a few years ago, right, during this stretch over here where it was floored at zero, right? These institutions were really fighting for rate. And one thing that you'll notice with Jerome Powell being in charge about right here-ish is that he's either all the way on the gas or all the way on the brakes. And that's why I tell institutions all the time is watch, Jerome Powell's either all the way on the gas or all the way on the brakes. And right now, we just had a 50 basis points cut. And in fact, you can Google this yourself. Go to CME Fed Watch tool. I may have brought this up before, but it'll give you the probabilities of another Fed rate cut by a certain time, right? So if we go a year out from now, October of next year, so the current rate's between 4.75 and 5.0%. Let's just round it and say 4.75. This says that there's a 32% chance that it'll be at 3.25. So another 150 basis points cut, right? So that would be 2 full percentage points cuts within 1 year. And that's got the highest probability, right? We could go to May. So let's say that's not quite 6 months. Let's say that's like 8 months from now. Eight months from now, we're saying at least a 43 plus 37, an 80% chance that it's 100 basis points lower than it is today, right? At least an 80% chance in the next 8 months that we're going to have the Fed interest rates 100 basis points less than they are today. And that controls all other interest rates in theory, right? So let's continue on here.
drop of 0.5%. And if we zoom in on just the last couple of years, here's what that little drop looks like. Now, many people have been waiting years for the Federal Reserve to finally declare victory against inflation and start lowering interest rates in order to make debt payments more affordable again. So many people were very excited when the Federal Reserve finally announced that yes, they were moving forward with rate cuts, and the first one was starting off with a bang at 0.5%. But this interest rate cut had the opposite effect on pretty much all other forms of debt. We're about a month removed now from that meeting where the Federal Reserve cut interest rates, and yet interest rates across other forms of debt have actually started to rise. If you take a look at mortgage rates, you can see that they bottomed at the end of September and since then have been moving higher.
That's interesting because the mortgage rates are generally tied to the 10-year treasury, which is not the Federal Reserve rate, right? The Federal Reserve is an overnight rate. The 10-year treasury is a 10-year rate. Okay. Generally, mortgage rates are tied to a 10-year treasury. I don't know what it is off the top of my head. I haven't looked at it in a while, so I'm curious to see if he's going to talk about that.
And while 15-year mortgages are lower than 30-year mortgage rates, they still are following the same trend of moving higher since bottoming in September. Now, this one in particular has made many people fairly upset because your mortgage payment is the largest expense for most people. Many people who purchased homes within the last couple of years have been
Those people except me. He hasn't seen my wife on Amazon. Good gravy.
waiting patiently for the Federal Reserve to lower rates so that they could refinance at a rate that was more affordable for their budget. However, rate cuts have not had the expected effect on mortgage rates. But it's not just mortgages. If we take a look at credit card interest rate, they just notched a new all-time high at over 21% on average. Now, if you carry a credit card balance, that is one of the surest ways to prevent yourself from ever getting wealthy. It is very easy. It is a slippery slope to get into credit card debt so steep that you cannot get out. But even if you don't go that far, carrying a balance simply means that every single purchase you make with that credit card becomes more expensive. And now it's not just 14% more expensive, it's 15 or 18 or 20 or 25% more expensive. And remember, this over 21% average for credit card interest rates is the average. I've seen numbers over 35%. There are no investments that have that rate of return consistently, yet you are that investment for the bank. If you can use a credit card without carrying a balance, fine. But if you can't, treat it like an addiction, cut it up, stay away. But it's not just credit card debt either. If we take a look at the interest rate on new car loans, that just notched another high at 8.76% for 72-month loans versus the prior high in November of 2023 at 8.67%.
Well, I gotta say, I am surprised, but also at the same time, one thing I do with consulting is I talk about the lag time between market rate changes and what they actually pay, right? Or what they actually charge. And generally, in a nutshell, as rates go down 100 basis points, in theory, they're not going to take the loan down by 100 basis points. They could, but in theory, they're not, right? And especially right now, if they can maintain that spread, I don't see why institutions wouldn't keep their rates high, right? It's really only until we find the consumer demand where they're saying the Fed just lowered rates 50 basis points, or 8 months from now, the Fed just lowered interest rates 150 basis points. Why am I still paying over 8 percentage points on this auto note? Well, it's because the financial institutions had no monetary incentive to lower that rate to you as the consumer. So I'm not really surprised that these haven't changed all that much yet.
60-month auto loans as well just notched a new all-time high at 8.4%. If you've been following me for some time, you know this is exactly what I've been predicting for a while. The Federal Reserve will cut interest rates, but it will not result in lower prices or lower interest rates for the rest of us. Credit card.
We're a month out, right? That there is a lag. There is always going to be a lag, no matter what, right? Institutions don't just watch the Fed and they're like, Jerome Powell, go, right? And then they drop their rate. It's just not a thing, right? So I'm not surprised that we aren't seeing, a 50 basis points cut across the board. So I'm not really buying his theory just yet, but let's let him explain himself. Randy, good to see you.
Debt is more expensive now, mortgages are more expensive now, auto loans are more expensive now, and it doesn't even stop there. Since bottoming in September, interest rates on 10-year government treasuries have...
Okay, there's your 10-year treasury curve that we talked about. And I was curious to see where it went, right? And it seems as though it is going higher, which means that the demand for these should be going down, right? Because price and yield on these are inversely correlated, right? So as the yield goes up, that means the price of these is going down.
risen back above 4%. Yields have risen on the 20-year as well and on the 30-year. The only government debt that has not gotten significantly more expensive over that time is short-term government debt underneath 1 year. So what exactly is going on here, and why is debt getting more expensive almost across the board, despite the fact that the Federal Reserve has now started cutting interest rates? Before I answer that, I want to tell you about something very important I have coming up. It's no secret
No.
days
Let's get to it.
rule. I want to show you call are limited. Look forward to seeing at the 30-year, the 20-year, the 10-year, auto loans, credit card rates, and mortgages. None of these are outright controlled by the Federal Reserve. Some of them the Federal Reserve has influence over, like treasury rates and mortgages, because the Federal Reserve buys some of these loans from the open market. When you buy up debt, all else being equal, that's going to drive down the rates because bond yields and prices are inversely tied. So when you buy up debt, it drives the price up, which drives the yield down, and vice versa. If the Federal Reserve decides to sell a bunch of debt, it'll drive the price down and the rates up. But again, that's all else being equal. They are not the only player buying and selling that debt. For instance, with US Treasury debt, you also have the federal government, and every time they borrow more money, that's the same thing as them selling more debt onto the market. That's going to drive prices down, yields up. But even the federal government is not the only big player. You also have large financial institutions that are buying and selling this government debt on a day-to-day basis. And so with interest rates on long-term government debt headed higher, that tells us something that the free market is anticipating. And what they're anticipating is future inflation. You see, the September CPI report came out hot, higher than expected. This is evidence of what many of us have known for a while, that interest rates that are too low set by the Fed allow the government to spend more and borrow more than they should. Because all dollars are loaned into existence, this increases the money supply, which drives up prices. And while the federal government may have a hard time borrowing at the long end of the curve with 10, 20, and 30-year treasuries, they're having no problem right now borrowing at the short end of the curve with things like T-bills. So as the Federal Reserve lowers rates, they're basically only making it easier for the US government to borrow short-term debt. This allows them to spend more, borrow more, driving newly created money into the economy, driving prices higher. Now, if you're going to loan money for a long period of time, let's say with a mortgage for 15 or 30 years, or a credit card debt that just keeps on getting rolled over, or an auto loan for 5 or 6 years, or to the government for 10 or 20 or 30 years, you're going to want some sort of assurance that not only are you going to get your dollars back, but you're also going to get your purchasing power back. Because if your total pile of dollars increases by 5%, from $100 to $105, but everything that used to cost you $100 goes up in price to $106, yeah, you got your money back, but you didn't get your purchasing power back, which means the Federal Reserve is in a catch-22. As they lower interest rates, mainly at the short end by lowering the federal funds rate, which is the overnight rate, they're increasing the inflationary pressure on the economy, especially for the long term, which drives long-term interest rates up higher because it enables more government spending and deficits. And this is not just some theory that some guy on YouTube has concocted. This has happened before. In the 40s, the debt.
Listen, as another guy on YouTube, I appreciate him saying that. That's what I say all the time. I'm just a random guy on YouTube.
Debt to GDP ratio was over 120%, just like it is now. Over the following 40 years, the government deleveraged as they printed more money and the Fed held interest rates low, so the government could deleverage relative to the size of the economy. During this time, inflation rose, and the Federal Reserve had to continue to raise interest rates. And even things like the 10-year bond yield continued to soar higher, which meant interest rates and prices went higher for everybody. But the key thing here was that the Federal Reserve made sure the government could deleverage through things like yield curve control and other tools the Fed has up their sleeve. It's the exact same playbook now. We are in a long-term cycle of a government deleveraging through inflation. Higher rates and higher prices for us, more borrowing and more printing for the government. And in a world of easy and infinite money, you definitely want to hold more and more scarce and hard assets. As always.
I don't know. That was very doomerish of him in that. Let me know in the comments what you think. Do you think he's right? Do we feel like there's more inflation on the horizon? I don't know, right? That's not necessarily my wheelhouse. I will say I have been personally quietly hoping for a deflationary environment, right? But deflationary environments are bad. They're bad for everybody, right? Imagine, right? I'm not going anywhere in my house anytime soon. But let's say I needed to sell it. And when I bought it, let's say it was $500,000, and now today it's $1 million, right? In a deflationary environment, all the buyers are sitting on the sidelines and they're basically licking their chops. They're saying, you know what? Chris needs to sell that house, but he ain't gonna sell it for $1 million. They're all looking around and they're like, we have the power here, right? So then they can just sit out and say, okay, Chris, what are you going to do? So I lower my price by 100,000 to 900,000. They're all looking around like, this fool just caved, right? He just made the first mistake. He lowered his price. Now we get to sit and wait to see just how low he'll go, right? And then it becomes a spiral where it's like, I don't find any buyers at 900 or 800 or 700 or 600 or 500 or even 400. Now I'm looking to sell my house at a loss, which I do not want to do. And so, like, rather than stimulating the economy, I basically held back the economy, and everybody else held back the economy because all of the buyers are sitting there saying, I'm just going to wait for prices to come down. All of the sellers are saying, why is nobody buying our stuff? And then at the same time, no money's changing hands, right? Nothing's happening. And then you get to the other end of it, and there's layoffs, there's closures, there's total system collapse because nobody wants to buy anything. And if nobody's buying anything, then there is no commerce, right? No, I don't want that to happen, clearly, but I would really like to see prices come down. I don't want to see inflation come down to disinflation levels. Disinflation means the rate of inflation is slowing, okay? But disinflation still means a positive inflation number, meaning it's greater than zero, okay? If inflation is greater than zero, that means the price of your good today costs more than it did yesterday or the year before, whatever your time comparison is. So, I don't know. It's a real catch-22, and that's why people who are smarter than me are running the Fed, and we'll see where that goes. Randy says, tough question. The total federal debt is ridiculously high, and that is the biggest problem I see. No joke, dude. Like the servicing on debt, I don't remember the number I heard, but it's like it's about to be the most expensive thing in the entire country, more than the defense budget, more than all this other stuff is our basically our interest payments to everybody else who owns the United States debt. So that does make me a little bit nervous. Let's jump into our market analysis. Welcome to the OVTLYR trading room. This is smart trading made simple. This is where we save time, make money, start winning with less risk together as a team. And for those of you who don't know me, I'm your rich Uncle Chris. I've twice been awarded top 100 people in finance. I've been successfully trading since 2009. I'm a partner with OVTLYR, and this is my style of trading using OVTLYR. Randy says it's not just expensive, it's 120% of GDP. Good gravy. So this is my style of trading using OVTLYR that I call the golden ticket trading strategy. Real quick, how does OVTLYR work? It's a 4-step process. Number one, OVTLYR monitors how investors are reacting to changing market conditions, news, price movements, and the economy. Number two, OVTLYR determines if investors are acting irrationally, fearful, or greedy, and by how much. Number three, OVTLYR gives buy and sell signals when those irrational behaviors reach an extreme. And number four, allows you to get into the stock before anybody else with the OVTLYR move, right? So let's talk about today's member highlight. Click a button here. Here we go. All right, so pretty quiet weekend, as you can imagine. But we did have a couple newcomers here, which is exciting. Glad to see new people joining on the Discord. And then Tug, just earlier today, said that he noticed the Ultimate Trading Power Pack that I stealthily added to the VIP Investors Toolkit today. Yes, sir. So this is actually really cool. So Tug says, I just noticed the Ultimate Trading Power Pack posted to the VIP Investors Toolkit. Outstanding. Thank you, Chris and OVTLYR. I've been going through the previous trading room videos to build knowledge and understanding, but this is the mother load all in one place. So thankful to be an OVTLYR. Woo. I'm going to add this to our share your big wins section here real quick, because I love this kind of stuff. Boom. And then am I right on here? Add it for Tug. There we go. So what in the world is the Ultimate Trading Power Pack? Well, let me just show you here. You go into the VIP Investors Toolkit and then click this link down here, and it's going to pop open a Google Drive link. In here is some really cool stuff. So first is all of the extended edition. And I call them extended edition because honestly, I recorded these 5 years ago and I'm not going to record them again. Hang on real quick. Of the Secret Investing book. Hold tight. Ugh. Okay. There we go. The Secret Investing book that yours truly wrote. And like I say, I recorded those 5 years ago and I'm not recording them again. So they are the extended editions. Also in there is all of the lessons that we've been going over the last several weeks, from this here. We've talked about it many times, all of the different all the different things, all the different lessons that I wanted to go through. Basically, it's everything inside of the trading strategy, right? Top to bottom, all in one place. And so this is one of our projects that we've been working on over the last couple of weeks. And so all of that is in here for you, right? You can click any one of these lessons, how to position size for volatility. That's going to correspond with, as you would imagine, position sizing with volatility. Who would have thought? Right. And so it's the video that we did, but these are not going to be on YouTube. The only way that you can get these is in the Discord through the VIP Investors Toolkit. So where's that at? How to position size with volatility. And then this will pull up I've been trying to understand the risk management formula video here. And then you'll see me going through it top to bottom, explaining. It is the clip from our trading room, but it's not available for anyone anywhere else. Right? If somebody wanted to go like dig deep through all the archives, they could eventually find it. But why do that when you can just literally come in here, get this drive, and say, "Oh, how do you use the ATR indicator the right way?" Well, daggone, Chris, all about it, and you'll see me 99. We'll just round to 0.5. All about it. 71.36. Right. So this is going to be super useful for you. This is something you want to hold on to forever. Because in theory, I've explained everything in as much detail as humanly possible and how to do the golden ticket trading strategy. Our half ATR, and then I tried to articulate it as best as possible in here. And so this is the hand holding that you've been looking for to help you stay on track, to figure this out, and to trade it the right way. Now, big picture here is, as you've seen, our results using this have been outrageous. So it's unbelievable, outstanding. Times the 2,500 shares. I'm currently debating what the plan will be for next year. I love the idea of doing the US Investing Championship. I love the idea of doing it. But I don't know what that entails. Yes, we're saying we want to take 5% of risk. Okay. But really, what I want to do you can't always get out at the half ATR, right? Trade with this. There are days where it's gap down and it freaking sucks. Get more data points to go with this, and then I think we could put this together into like an actual book, right? And everybody's familiar with the how to make money in stocks, and see if we can get that published as a how to actually make money in stocks, right? And I think bigger picture, like longer term, bigger picture. One of my all-time favorite books is The Man Who Solved the Market. Is huge, yeah. So this is why it's a great example here, and that's why I always use those two. The story of Jim Simons, currently trading at, and I had the opportunity to meet the author Greg Zuckman and chat with him on it. But this is one of my all-time favorite books. I have a feeling that they're going to rewrite this book, and it's going to be the man who solved the market with myself. So I'm really excited about this. Sebastian, good to see you. Wes says more borrowing, more spending, more inflation, poorer people, but it turns out voters every 2 years. Do I have a video playing in the background? Oh, I do. Sorry. My bad. That was left on. So anyway, I'm very, very excited about this. So go back over here. Be sure to share your stories in the Discord. Let us know how we can help you. Let us know how OVTLYR is working for you. And of course, the first rule of OVTLYR is you tell everybody about OVTLYR, because that's really the best way to spread the message. And of course, hit the like button to tell YouTube to tell everybody else about it too. And it's totally free. Now let's get to the market. We want to see the 10 over 20 price over the 50 on the SPY. And I think we have hit our top. I don't know how long it's going to be, but this is Chris's opinion. I think we've hit our top today. Short-term top. I'm not saying that we're about to crash. I never want to call it crash, but I think we've hit our short-term top. Now, why do I say that? We've got a sell signal on the Dow Jones, a sell signal on the Qs. We don't have a sell signal on the SPY just yet, but we do have a close below the prior day's low, right? Right there, that is a bearish sign. It's profitable for me. And if you had traded the OVTLYR move right here, that would be a profitable spot for you. In fact, let's go to that. Here to here. The OVTLYR buy signal will give me about $9 so far. Now, I'm not saying that we're about to get a sell signal. I don't know. But to me, this is a bit risky. This is a bit nerve-wracking. But you've got your behavioral heat map chart. Actually went up from Friday. It's a G11. And then the oscillator here, the trajectory oscillator, is actually looking like it's going up. So I could be totally wrong, but to me, this does strike the you might want to hang tight for a minute sort of opinion here. In fact, let me remove this. This was just for example's sake. But you've got the 10 over the 20, price over the 50. So this is a bullish trend so far. And then if we go to the next step for the market breadth, this is actually pretty cool. We have seen a potential bottom on the breadth. So 29 new on the bull list today, 14 new on the bear list today. And the breadth is maybe starting to turn around. You can see that it may have found a bottom and it's turning around. So here's the game plan. It's very possible tomorrow, if we get a strong number of stocks on the bull list here, that this could cross over, right? And I may have to eat my words and say, you know what? Bullish trend, bullish breadth, gotta go. But a little bit anxious here with this close below the prior day's low. However, this was a close below the prior day's low, and then it rocket shipped right off that. So we'll just have to see how it goes. But I don't have a trade to put on today because the master key's locked up. We've got a buy signal here. This is bullish. This is still bearish, but getting a little bit more bullish. Sector breadth. There were only 2 sectors I saw this morning. I actually really like doing this while I have my cup of coffee, just going through and looking around. Financials and healthcare were the only 2 this morning that had bullish breadth. So one thing that Mark asked us to do was to start looking at stocks. And if you remember, we talked about this last week. Start looking at stocks that are currently in a sell signal and see if we can identify anything to get into the see if we can identify anything that allow us to find the buy signals sooner, right? We got the data here. Are there any patterns? Are there any things that come up that say, hey, maybe it was a buy signal earlier today? Hey, Dave, glad you made it. No worries. So what I want to do is we have which 2 sectors were those? Financials and healthcare. I want to run my screener. Now, I've not done this ahead of time, so I don't have anything prepared. Change that to bullish, right? But I want to make it so it's only on the sell signals. Now, what this will do is it'll give me everything, but still with the sell signal, right? So you've got your heat map values, you've got your oscillator moving up, you've got a green overlay, everything basically, with the exception of a buy signal to see, hey, you know what? Is there anything that could have told us to look a little earlier? So these are organized by signal start date. Let's go oldest to newest. This wasn't one from August, HIG, H-I-G. Oh, I wanted to do just those sectors though. That was healthcare and financials. I'm gonna have to remember to have those filtered. I won't forget. All right, HIG is in the financials. Okay. Taking a look on here. All right, so that sell signal came here on August 8th. And looking at the oscillator, you can see it did move up for a while, the blue line. You can see the heat map value went from G25, was at G25, then 24 for a while, and 25 again, and 26. So this may have been a decent entry point. And the reason I'm saying is that you saw the heat map values go down from G25, floored at 24, then went from 25 to 26. So we've got a confirmation it's moving back up. You've got your oscillator moving up. So that would have been on August 27th on HIG. So one thing that Mark wanted to do was have us looking at this, because there is absolutely, if you are interested in looking at charts, a different way to trade than I do, right? Instead of waiting for those buy signals, you might go in there and say, okay, you know what? Here's some data points I see. Oh, you know what? I could have got in a little earlier, right? So while this is still sitting in a sell signal, you could have traded right here, which, let's say you went from close to close there, 2.5% gain, right? A bit of choppiness right there, but still, that would have been a decent entry. Let's go to the next one here. ISRG. So we've got our green overlays. And then we see the heat map, right? You can see it just like falling off a cliff. So it started on the sell signal at G34, goes down to 12, 11, 10. It seems like it flattens at 10. Oh, then it keeps going down, 7, 8, 9. Okay. So 7 was the bottom, and then 8, then 9. So let's say potentially yesterday, this cursor thing's right in the way. Let's say potentially yesterday could have been an entry signal, ISRG. You've got your oscillator moving up, you've got your heat map, finding the floor, and then having a little bit of a comeback. So let's go to ISRG. Well, that certainly wouldn't have been a good one today. And I'm not saying it's going to be. I'm just doing theories around here. Yeah, that would hurt right there. That would hurt real bad. Let's go to the next one. Lilly, LLY. Eli Lilly. So you got a sell signal. Oscillator has been moving down basically the whole time. Now it's just starting to flatten and come back up. But we don't quite have on the heat map yet. The lowest values are 11, and today is our 10. So maybe let's try APO. I think I looked at APO this morning when I was doing this. Oh, duh, sorry. Are you on it? Yeah, I did. This is one where I saw a couple things. It's still in a sell signal, but huge move right there. Now you've got your oscillator moving up, and then maybe waiting for the green, right? So let's say, for example, if you were somebody who's looking at charts, coming up with ideas to trade, rather than waiting for the buyer sell signals to come through, you can see the oscillator's moving up, the heat map is moving up, and then we get into this green uptrend with September 23rd, which was right here, this line, okay? But one thing I noticed is that these seem to do really well when they break a recent high. So I think I saved a few of these as examples. So like APO, while this was breaking a recent high here on September 16th, that was still in the white overlay. But once we got into the green overlay and we broke that recent high, that was pretty great. In fact, let me go here. Mastercard, I think, was one. Yeah. So Mastercard, which was right here. Sell signal. And then the oscillator was still moving up, and so is the heat map. Look, I'm not saying I know what goes into the buy and sell signals, but I'm just looking at the data I have here. So what I was seeing this morning was September 9th, which was that sell signal. Yeah. Yeah, really not sure about that one. Let's go to Met. Oh yeah, Met was one I wanted to look at. MetLife. This will be the last one. All right. Sell signal here. Oscillator moving down. But then oscillator flattens out and starts going up. And then you've got the heat map going from 25, 24, 23. 24, 25 again. So this would have been the date that makes sense to me if I'm looking at it. And that is September 19th, which is this, no, one day after that, this date here. And you can see it did break out of a previous recent high on that day. And then it has taken off since that point. So interesting things to look at. And of course, our objective here by doing that is to see how can we make these signals better for you, right? We've already got some amazing signals, but how can we make them even better? Right? We're always trying to make things better. So with that out of the way, thank you again for coming today. Thank you again for being an outlier, right? We literally couldn't do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk. Well, Jorn, it's not that my system is better or worse, but like if we can incorporate something that we've observed, right? Maybe something that we observe through this allows us to find those data points a couple days earlier, and then we all make money, right? Save time, make money, start winning with less risk. We make more money easier a couple days earlier on the stock move. That would be really cool, right? Because, you know, number 4 on this step here is getting into the stock before the move happens, right? So if we can get in even a couple days earlier, I mean, let's go. Because on this MET signal here, we didn't even get a buy signal for this move, right? It's been a great move, but a great move without outlier in this case. So just trying to make it better, right? That's what we do at Outlier because we do this together as a team. Don't forget, you can save 45%. You can get access to the annual plan for just $329. That's only 90 cents a day. And let us know if you need anything over in the Discord. Don't forget the first rule of Outlier is to tell everybody about Outlier and to hit the like button because that tells YouTube to tell everybody about Outlier too. And it's free. Have a fantastic day. See you right back here tomorrow. We'll talk soon.